Good morning. My name is Maurice Crespi. I'm the managing partner of Schindler's Attorneys. Schindler's Attorneys is a co-founder of COBRA, together with IQ Business and Engaged Business Turnaround. We put together COBRA as a pro bono initiative. The idea is to assist businesses in distress wherever we can, wherever possible. We've put together the most extensive knowledge base in South Africa in relation to COVID-related issues. You can find that on the website, www.cobra.org.za. We facilitate mediations between your creditors and your debtors. We arrange private Zoom sessions. If you like, we'll meet with your employees. We can meet with you, your team, and we can answer industry-specific questions. What we also do is we host these webinars. The idea behind these webinars is we have industry experts come in and assist with sharing their ideas as to how best to tackle the issues that we currently face in our respective businesses. So today we have New Capital, who will be dealing with how to best raise capital in the mid-market segment. Now, bear in mind that COBRA is about all segments of the market. Yesterday we had Gigi Alcock dealing with the very low segment, the spaza shop segment, and then we go all the way up, and we also deal with big business, the likes of IQ Advise and New Capital also advise at that level. So to introduce my panelists, we have Mark Taylor, who's a former executive at Richmond Remgro and head of investment evaluations at Venfin Banking. Trust company and family office experience he has with Investec and associated businesses, hands-on turnaround experience as the CEO, licensed senior business rescue practitioner. He developed the first aquarium in Turkey, and the list goes on. He has several published articles that you can find on the COBRA website. In fact, if they're not posted, we're going to put them on because I have them on my information sheets, and I certainly think they'd be of interest to the audience. Then we have Barry Hawke. Barry is the head of equities and valuations at New Capital. He has 24 years experience in the equity capital markets and corporate strategy consulting. He has roles in Nedbank, CIB, and institutional equities based in Johannesburg, where he held those positions between 2014 and 2018. Between 2002 and 2013, he was the managing director of Holt EMEA, Credit Suisse Equities, based in their London office in the UK. We have Gordon Bell, his debt, equity, and operations. He has experience in African real estate, exec positions in credit, property, and trade finance and Investec, Nedbank, corporate, Barclays Africa, real estate operations at Octodec, Brol Africa, and again, the list goes on. So I'm going to hand over to the guest panelists today, but before I do, I'd like to introduce the other panelists who are from the COBRA partners who are joining us today. We have Renee Klopper from IQ Business. We have Peter Gordon from Engaged Business Turnaround. We have Emma Marseille from IQ Business, Gary Barachowitz from Schindler's Attorneys, and Tasneem Khan from Schindler's Attorneys. So over to the New Capital guys. Thank you so much for joining us today, and thank you so much for sharing your insights. Over to you.
Thanks very much, Maurice. Really appreciate it again, and good to be on the panel. I think what we really wanted to do today was focus on how you raise capital generally in the market. Certainly, we will be approaching it from the position that most businesses in the world are stressed at the moment anyway. There are slight differences when you're distressed, and there are obviously differences if you're in business, actually going into business rescue. So there will be we'll try and comment on those as we go, but our approach will be generally to consider it from the broader perspective, and then narrow down to those areas. And please keep a note of your questions, and we'll deal with them as they come up. The first thing, perhaps, just to tell you a little bit about ourselves, and that is that we are a bit like a Tinder for African capital. We match capital. We are not an investor, we are not an advisor, a corporate finance advisor, and we are obviously not a company that's raising money itself. We sit in the middle of this process. And so a little bit like the elephant in the dark, when you've got a number of people in the dark room and come across an elephant and you can feel the tail and you know what the tail is like, or you can feel a tusk and you know what the tusk is like, or the ear. In some respects, we are able to see a much bigger piece of the elephant, perhaps like the elephant in candlelight. And this is because we work with hundreds of investors who often compete with each other and don't talk with each other. And the second thing is we work with dozens of corporate finance advisors who, again, compete with each other and often don't talk to each other. And then finally, we speak to hundreds of companies who are raising capital, and they often don't even know about each other. So we do get a chance to see a piece of the capital raising process, which is quite unusual. It means that we have some particularly useful insights, and we want to share those with you today. But because of this role we play, we obviously always respect our confidentiality, and we play as a very neutral party. So new is for neutral. And so we will try and pick up on these pieces as we move through, relating to the more stress situations as well. So we plan to cover today deal criteria, the deal process, closing a deal, the shifts that have taken place in the markets, and we'll take some questions. And perhaps also, what is the mid-market and why do we operate in this 50 to 500 million rand range? Well, we see the world divided up between smaller businesses, which Gigi would have covered, but also businesses raising up to about 50 million rand, might be 5 million rand for a lifestyle business, 10 million rand for a startup, whatever. And they operate, and so that's the sort of smaller end of the market. The mid-market that we operate in is generally underserved. It has a manageable number of investors, of sophisticated investors that we deal with, and we are not yet then bumping up against the big banks that are dealing with, Investec, the Rand Merchant Bank, who are dealing with the very much larger transactions. So we focus on the mid-market because we think that's a place where we really can add value and our model adds value. So that's why we think we know a lot about that. My background is also in VC at early stage, and Barry's background is obviously in very large raising. So we can comment on those things to the extent it's valuable. So I'm going to hand over now and just ask on the deal criteria, Gordon and Barry, just to walk you through some stuff. So thank you very much.
Thanks, Mark. Thanks very much. Thanks, Barry. Just, one of the first criteria that you need to do is your investment and your credit committee at banks normally deal with debt, and your investment committees or equity committees deal with the investment side and the equity side. Now, they're normally two different committees completely. And I remember I always used to have a little maxim I used to say to my relationship managers in the bank is, don't take crap to credit, excuse the expression, but that's what I used to say. Is very often that's your best chance, the first time that you actually table the deal. So just make sure that the deal that's tabled to your credit committee or your investment committee is a good quality deal. It will come later to what's, the actual presentation. But you really need to understand the credit committees, how they work, and also the investment committees. You'll find that in the equity space, often they tend to back the jockey, whereas in the debt space, it's more the balance sheet of the operating company that becomes important. So, just understand getting information timeously, getting good quality information to your relationship manager so that he can transpose that into a decent credit paper to submit to his committee, and get your best foot forward in that first sort of presentation to credit. Yeah, Barry, then perhaps a track record.
Yeah, so it's helpful that the business has a track record. We have distinguished between strategic or strategic investments into a business, where often it's an equity investment, controlling stake, versus a financial investment. So the bulk of our investor base are looking to make financial investments. They're not looking to come and take control of your company. And it could be in the form of equity or debt. So if your business has an existing track record, that de-risks that process. It's got an established business, it's got a revenue, it's got an EBITDA, it can support a financial investment, it's got the balance sheet to do that as well. There's a risk-reward profile that actually is a little bit more favorable towards the investor, in that the business already is a proven model. And often those investments are for growth, and it's a replicable business model. So think of the successful coffee shop on your street corner, maybe not a successful time for them now, but if they are very profitable, then they could replicate that into other sites. So having a track record is very helpful in the capital raise process. Without a track record, you then start to fall into the venture capital strategy. So we're typically talking about businesses where the investors want to make financial investments, and they have an existing 3 to 5 year track record where they are profitable.
Maybe I can. Sorry,
Karen on.
No, shoot.
Yeah. So what that does mean as well is the kind of investor base that we're working with is able to, we can recycle them into a number of other investments. This is not the only one they're going to make. So if I've got a big strategic buyer who's going to make an acquisition, a controlling stake in a business, that'll be a once-off transaction, and they probably won't make any other investments like that for a while unless they're serial acquirers. But the financial investor is always looking to diversify his portfolio and make investments into a number of different businesses. So if they make an investment in your business, there's no reason why in a couple of months' time, once that's bedded down, they may not make an investment in another business. So they're managing like a portfolio of potential investments, and there's a degree of diversification that they're looking for. It does also mean you, as the company that's been invested in, retains control, and there's less disruption to your strategy. And both sides are looking to grow and facilitate that through adding capital, both in terms of the business and the capital base. So you've got an alignment there in terms of how that would fit. And that's quite critical to be able to clearly articulate that in the capital raise process.
So if I could just take that, Barry, back to the idea of stressed, distressed, and business rescue, because I think that becomes relevant as well. You know, the financial investors, and just for those of you who perhaps not familiar with that term, but a financial investor is someone who's looking for a financial return. They're not looking to control. They're not looking for a strategic acquisition, which is going to extend their distribution. They are typically private equity funds. They may be family offices, banks. They will be investor. There might be mezzanine fund investors. The strategic investors are those businesses who want to acquire, control, perhaps eventually absorb your business completely, but they're looking for a business benefit out of the deal as well as a financial return. So if you make that distinction and you think about a business that's getting into stress or distress, the less attractive your business is becoming as you get into trouble, the less likely you are to attract a financial investor, because a financial investor wants a return. And the more likely you are, if you have, for example, an embedded distribution network, but you're making a loss, you may find that for a strategic investor that becomes interesting. So you will see a shift through depending on your level of stress. And very often when your business rescue practitioner, at the point that they're going out to market, they are no longer really able to, it's not so easy now to go and find financial investors. They're more likely to be looking for strategics. And on the one hand, and on the other hand, the existing creditors become a source of capital, and perhaps even future capital to provide some support to rescue the investment they already have. So the business rescue practitioner often sits in an interesting place because they're dealing with strategics, or they're dealing with banks who would not normally want to be there. So it's an interesting space that they play in, and it's slightly more complex than a traditional capital raise. So I hope that's useful. Do you have anything else, Barry, to add?
No. Mark, you want to talk about respected advisors?
Yeah, so moving on to advisors. So I think the next thing is that prior to, in the mid-market, you are typically dealing with 50 to 500 million Rand raises. So you want to be working with a high-quality corporate finance advisor. This is not a space for a do-it-yourself. You can do it yourself if it's debt, it's a bit easier. But if you're dealing in trying to raise equity, you have to be able to value the business. You have to be able to negotiate shareholders agreements. You've got to have a view on pricing. It's a very much more complex process, and you really need someone to hold your hand through this process. So the process then is not that you're dealing with, it's useful to note that the corporate finance advisor then will be someone who's very experienced in investment banking. They're not like an estate agent. They're not a broker. They are highly skilled professionals. They have a detailed understanding. They'll have a detailed understanding of your business or learn about it. They'll build financial models. They prepare an information memorandum. They'll find investors. They negotiate the deal for you. They run the due diligence. They manage the agreements with the lawyers and make sure you get paid at the end. And that's the process when you're raising capital with a corporate finance advisor. It's an extremely complex process. In our lives, what we do is we really become in our lives, we are simply their outsourced distribution partner, so we can distribute the deals to investors. That's the piece that we play. But these are not trivial people, and they're not like estate agents. in quite the same way. So a good corporate finance advisor is worth their weight in gold. You cannot pay enough for them, to be perfectly blunt about it. But in the mid-market, which has some great advisors, some awful ones as well, and it can be difficult to distinguish. But it's just important to know you need a respected advisor that the banks, that the private equity funds, the family offices will respect and take seriously. And if they don't have a brand name, which is not always as important, they need to have a presence and understanding and be able to have some gravitas in meetings. So those are important features of the respected advisor. Do you want to just talk about the IM, Gordy?
Yeah, sure. I'm just having to unmute. Yeah, one of the key things as well is on your business to develop a quality IM, or information memorandum as we call it. You know, often I would go and see a client, a captain of industry, go and see him at his premises. He's got a very skilled accountant who spends his life working late, getting the accounts up to date, etc. But when it comes to actually presenting the business to the bank or to the institution that's doing the lending or the facilities, it's like a voyage of discovery. You sort of dredge for information, you find, you hope you find stuff. The sooner you can present accurate, up-to-date financial information and a good executive summary to the funder on your business, also demonstrate things like serviceability, risk mitigation, you know, even just a little simple SWOT analysis to demonstrate that you've thought through the strengths, weaknesses, opportunities, and threats. Do everything you can to assist the relationship manager. And that process is called investor readiness. So when the investor or the lender comes into your organization, it's great if you've got your little pack prepared, your strategic pack. It sets out your business, the strategy that you thought through. And then you just update it from time to time with new financials, etc. It just makes your banking relationship manager's life, or your investor, a lot easier, that you keep that information up to date and it doesn't become this voyage of discovery, or all of a sudden, you know, you need a decision on funding and you want it in 2 weeks' time. You call your banker today, you suddenly find that it takes him a week to prepare the information. Then he's got to get the information to his decision makers, and it becomes this mad scramble, and often he's ill prepared. So the sooner you can present a succinct, it demonstrates as well to any investor or lender that you've thought through your business and you've got a plan in mind. And even if you're getting into a bit of a pickle, hey, risk is part of business, you know, how do you deal with it and how are you going to trade out of it? And demonstrate some realistic projections of how you're going to trade through the situation and what you're going to do. And just, you know, the information that you must be qualitative and quantitative. A lot of the bankers and the funders tend to think more sort of on quantitative, on the numbers and figures. And what's always very good with any information pack is on your top page, have a summary. And even if it takes you 3 days to write that summary, make sure that that grabs the attention of whoever's looking at the deal. And they say, quick business, the sector they're in, key issues or key accounts that they're dealing with. And then, hey, bang, here's the financials in a simple little table. Wow, okay, I've now got a snapshot. And then you can move on and go through the actual detail. But a quality IM is critical, and it's fundamental to any business. Barry, retainers, do you?
Yeah, so the topic of a retainer can be a sticking point in a capital raise process. Normally what you would do when you engage an advisor is there would be, certainly the better advisors, there'll be a discussion on paying a retainer to drive the process, and then there'll be a success fee for the capital raise. That retainer can become a little bit of a sticking point. And it's important to understand why it's there. So if you think about the profile of the investor that we're targeting in the 5 to 50 million dollar range, or 50 to 500 million rand range, he's managing a portfolio. He's going to be looking at least 10, maybe even 20 investments, which means his total portfolio is anywhere between $1 billion and 10 billion rand. It's a big number. So he's a sophisticated professional. And if you can't have young people calling him with potential ideas that you have, it's just going to dilute the impact of your potential opportunity in his eyes. So it's important to match the right people to engage with him. And also that they come to the table proving that they've been clever at understanding his mandate and understanding what he's likely to be interested in. And they've applied that to the opportunities coming through, pre-vetted them and screened them, and made sure there's a better match. So that gives him more confidence in actually giving you the attention that you need in order to facilitate closing the deal. There's a concept in the regulatory environment of the investment professional as opposed to individuals. So he's absolutely definitely an investment professional. he'll be qualified, he'll have experience, he'll meet a lot of very specific criteria in order to be able to manage money or other people's money. So it's important that you put the right people in front of him. It overall improves your chances of success, and it becomes quite a valuable role in creating the connections in the process. So it is very important to consider seriously paying a retainer, and in fact, almost ask yourself why you might be forced to not pay a retainer. And it may be some of the bigger banks have other mechanisms of monetizing the efforts that you'll be putting into. And typically in the mid-market, that doesn't exist. And you as a capital raiser don't want to hear about people trying to make money from you elsewhere. You want to be open, transparent, and engage with the people on the actual specific role you're doing there. So that's why a retainer is actually a very important way of keeping both sides honest, paying for the service that you're looking for, and ensuring the best chance of success. Mark, I don't know if you want to add to that or talk about exclusivity.
Yeah, maybe, and it's quite closely linked. I mean, these are features about wanting to make sure you're successful in raising your capital. I think when it comes to a distressed situation, you're typically then dealing with, you're probably dealing with strategic investors. There's quite a lot of work that has to take place with presenting deals also to strategic investors. Very often as the business person, you may know those strategic investors. And just to that extent that you're under an extreme stress, you can probably, you might be able to approach some of them yourself. But our experience is that the best time to get your advisor involved, your corporate finance advisor involved in this business is early on, so that you can start to work with them and strategize with them. It doesn't help to go, once you've gone out to 10 people to speak to them, they've all battered you. And now you go to the corporate finance advisor and say, look, I've tried all the big names in the industry. I don't know what to do. Can you help me? They're going to have a difficulty with that because it's going to be very hard for them to go back and reopen those relationships. It looks disingenuous. And secondly, you've left them then with very little to work with. So we would encourage, when you're working with advisors, that you engage them early on. And in the process of doing so, we find that exclusivity actually is a good indicator. If you grant exclusivity to your advisor, it's a good indicator of success. The reasons are the following. The first thing is that I worked at Venfin in the old days, in the early 2000s, and we would get at least an inquiry or two a day coming in. And the problem is that when you get an inquiry come in from the same person, for the same investment from two different people, you know there's a problem. You immediately know there's a problem with the investment. And even if there isn't a problem, you assume there's a problem. So you then tend to put the investment to the bottom of the pile, and when it pops up again, you knock 20% off the valuation in your head and start talking. Now, no one sees that happen, but it's how it happens because you sense desperation when it's coming to you from many different angles. And the second thing is you're appealing to ego. If you're an investor, you want to think you're special. And if you see that everybody else is also looking at it, it's a bit like your partner. You don't really want to. You want to know that you've selected a good quality partner. So I think that becomes quite important in the process. You don't want investor collisions to take place. That wrecks the value of your deal. The second thing is you want your advisor to become a team player with you. So if you think in terms of rugby, if you say to the forwards, look, you say to the backs, look, you're going to get an extra bonus if you score a try. And forwards, you're not going to get, you're only going to get money if you score tries, not if you win scrums. The problem is that suddenly all the forwards want to be backs, and you end up with a team that's competing with itself. And this idea of stronger together, that we had with our national rugby team, it falls apart. And so I think it's really important to know that you've got to work with your advisor. And the minute you start to carve out investors and say, well, I know these guys or whatever, you're starting to you're starting to compete with the advisor. And I think that becomes dangerous. I think it's really useful if you're all on the same page. If you think that you've got some great relationships, that's fantastic. But then negotiate the percentage fee that you're dealing with the advisor rather than trying to carve out. That would be my recommendation. And I think that the relationships you have, the next dimension that's important. If you have better relationships than the advisor, you should make those introductions. But it still means that the advisor controls, manages, and administers the process. So they always know where they stand. And the investor, when they speak to the advisor, they know that the advisor knows, he speaks with authority about what's going on in the process. Because an investor wants to know that he's getting the full picture. And then finally, you know, you can then at the end of it all, most people are worried about exclusivity because of the economics. At the end of it all, you can negotiate the economics. Negotiate the economics, but be careful not to negotiate the principle. The principle is really important. So that's probably the important feature around exclusivity. What it enables a person to do then is, so if your corporate advisor is trying to drive competitive tension, and she's got and she knows all the investors who are involved, it's very hard for a corporate advisor to run an auction process in Africa, and even in South Africa. You don't see it happening generally, not even in the mid-market. And it's really useful if she can drive the auction process, not formally, but she knows she knows what's going on at all stages and is able to keep, and the investors trust her to know that she knows what she's talking about. And that's a really important feature of creating competitive tension in a subtle way to drive the investors to making decisions. Because if you have to bluff, you can always, investors know how to call a bluff. They do that every day of the week. They know how to call a bluff on someone who claims to have 3 other people in the wings. So that deals with that. And maybe just if we can move to deal closure, Gordy.
Yeah, and sensible pricing expectations. Just to close your deal, rather than sit there haggling over price, just be very cognizant of the market at the moment. It's tight. You know, we're not post-COVID yet, and even when we are, pricing will probably remain. So if you get a half decent, if you get a decent offer from one of the institutions, then grab it with both hands, and be very careful of casual conversation at dinner tables. You know, and throughout my whole life, I've seen it. People will sit there and say, gee, you know, for my business, I managed to secure a facility of prime S2. When you scratch away, you find there was a huge raising fee attached to that. There was huge collateral, all sorts of other security had to get thrown in the pot. And the actual terms and the obligations of the client in terms of debt service coverage ratios and submission of financials every 6 months can be very onerous. And the other classic one is also insurance policies. I know very often some of the micro or smaller lending businesses stitch the clients into an insurance policy. That as you pay down your facility, let's say your facility is 200,000 and you pay it down to R1, you tend to still be paying the insurance premium on the original amount, even though it's not available to you. It's only available on a separate application. So my real point I'm trying to make there is don't just listen glibly to conversation at dinner tables where sort of a competitor friend of yours might say, gee, I got prime list, whatever for my business, because he's not going to tell you what all the terms and conditions, all the collateral were, all the little micro conditions that were stitched in there. So yeah, be sensible. If you get a decent offer or you get an offer on your business to borrow or to invest, then invariably grab it, because the market is quite sticky.
Maybe just before you go, maybe just to highlight what Gordon's saying, it's so important. And again, it's why you need an experienced advisor. If you're playing in the 50 to 500 million rand space, you know, little movements on pricing, on collateral that the security you're required to provide, or the obligations placed on you by a private equity investor. These are things that, you know, unless you're dealing with them every day, you will not know how to manage those. And if you were in corporate finance 10 years ago, you know, times have changed. And right now, in fact, if you're in corporate finance 3 months ago, times have really changed. So as you'll all appreciate. Thanks, Barry.
Yeah, and another potential blockage point at the deal closure end of the process is the dealer actually demonstrating that they are serious and committed to concluding a transaction. So if you are looking for an investment in your business, you need to really communicate that you're committed to coming to a conclusion over here. And this is more specific when in the mid-market space, dealing with investors away from the big banks and the traditional vanilla type equity or specifically debt investments, because your investor base is open to much more creativity and types of solutions they may structure. And you should look at being open and flexible to accommodating those. Ego can play a big role over here in creating brinkmanship at the final steps, and preventing a potential deal from taking place, and you realizing the potential of your business. And it's something to be incredibly sensitive about and try and manage, and perhaps even remove the people that have the ego clash from the specific part of this process. But I think the key point is demonstrating commitment, being open and creative to the potential solutions, because you've got investors who are going to be much more creative, and try and avoid the ego, etc., from blocking a potential deal. As the emotional constraint.
Yeah, then I mean, on emotional restraint, just, have emotional restraint. I think Barry's covered it already in his earliest point about being serious about your deal closure. The real issue there is just keep your ego at bay, because very often you'll go into the deal process believing that your deal is worth prime less plenty or whatever it might be. And you'll get an offer that might not be at the pricing that you want, and then your ego gets in the way. You think, no, I think my business is worth much more. I should get a much better rate. I've seen situations where the circumstances around a deal have actually changed, and all of a sudden the offer's expired, and the individual can't even get the funding that he originally managed to raise 2-3 months previously. So if you get a decent offer, then grab it. Try not to let your ego get in the way. If you feel, oh, I should be getting prime raise 2 on this deal, because that's what I heard at a dinner party. Yeah.
Perhaps just rounding that up, because I do think there's another feature about this, the emotional state. When you're in a stressed environment, again, it helps to have somebody who's fronting for you. It can also work the other way. You can also be in a situation where you are so stressed that that it's quite difficult to actually manage that, to manage your confidence levels in dealing with someone who's negotiating with you. And you may have things that bother you that go far beyond your business, that concern you, about your family, your health, whatever. So I do think that in a situation like this, it helps to have somebody who's your sounding board and who's presenting the deal for you and managing it. And I think that that's an important feature. It's a very dangerous time that you can make poor decisions under stress, both ways. The other thing, perhaps just to deal with on the process, the way in which you might deal with these processes. Once when you're under pressure with a stress business, bearing in mind, as I said at the outset, every business today is under some kind of stress, and many of them we're hearing through many of the bigger players are not able to even actually disclose this sort of stuff to their immediate financiers or their landlords or whatever, because they run the risk of being on the wrong side of a negotiation. So bear in mind that you'll hear a lot of people talking, oh, everything's okay. Things are not okay. They're very tough out there. And I think that that will also hasten the process of developing some of the stuff we've talked about, the IM, the importance of working with somebody who's very professional in getting your deals out there. And we work with these sorts of people all the time and have a lot of respect for the guys who are good at it. So maybe that covers that. I don't know if there's we have had some questions come in, and I can just perhaps quickly answer. We've had a question come in from Peter Duckworth. We'll answer Peter's question in a second, but in fairness, we should probably, if I may, Maurice, can we jump into questions? Or I've got the question also from Sebastian Chatov.
Yeah.
I'll pronounce your name correctly, Sebastian, but we have a question from him too, which we've got an answer line.
That'd be great. So if you just want to read the questions out and deal with them, let's just have a look. I don't see, yeah. So if you can do that, I don't seem to.
So I've got, let me ask, let's answer Sebastian's question. So thanks, Sebastian. Sebastian's from Palladis, and the question he asked firstly was which sectors are attracting capital. And in our, and I'm going to ask Barry just to refer to the article he wrote recently, which we published. So do you want to just quickly speak to that, Barry?
Yeah, Sebastian, we were actually asked by Maurice a couple of weeks ago to run a webinar. We talked about the investor landscape. We also talked about sector attractiveness. And we classified 3 lists, and we can make sure you get that link, of sectors, those that we thought are broken business models, those that we thought are likely to survive, and those that are likely to thrive. It's quite extensive. But I think a really interesting one that's popped up is within the tourism sector, which is clearly it should be in a survive category, but it's on its knees right now. But specifically within that is the game lodges and the nature tourism. There was a survey I saw last week by one of the top tour operators in Europe that surveyed over 600 of their customers. And the number one destination they want to come to when lockdown is lifted is South Africa. And the two things they want to do is come to our game reserves and go to our beaches. And that's great to hear that. But these businesses just need the balance sheet. They just need to survive this lockdown and still be open to get to that phase. So that's a good example of something in the short term that hopefully will survive, but I think in the long term should thrive. And we can post that list if you're interested. It was a subject of a whole webinar last time, so I'm not going to go through the whole thing right now. We'll make sure you get the link.
Then perhaps the other question that Sebastian asked, in fact, we asked 3 questions as I read it. Wanted to know what deal sizes are attracting capital. I don't know if you've got any thoughts on that, Gordon.
Yeah, I mean, we operate in the $5 to $50 million segment, or the 50 million rand to 500 or 2 billion rand segment. And we see an activity across all sectors. I mean, last week I had a deal in the 200 million rand mark that Barry and I actually both looked at. It happened to be in the real estate sector. It was at very keen funding, and I think the fee structure was also very keen. So that particular institution that lends into that sector, which is one of the big 4 banks or big 5 banks, I should say, in South Africa, is still lending, I won't say aggressively, but still lending confidently into that sector to the right clients with the right financials and the right scheme. And in fact, there was even a competitive bid from another bank, one of the big 5 banks, on that same deal. And the pricing was very similar, just the fee was slightly different. So, you know, certainly from what I've seen, unless Barry and Mark have different comments, I'm not seeing a particular band within our sector that's firing better than any others. It depends on the merits of the deals that are tabled in that particular sector. Barry, Mark?
Yeah, maybe just to add to that, I mean, I think the truth about raising capital is it's very, very hard to raise small amounts of, you know, I've been an entrepreneur, I've raised capital, and I've been on the other side of the table to the investors, as well as having been an investor. And, you know, you want to go and raise 500,000 rands or $1 million rands, you know, and it's more than you can round up around what they call the friends, families, and fools that you initially raise your money from, the triple F. So if it's always 5 million rand, it's just too small to get the attention of the professional investors. And so you end up having to talk to high net worth investors and people who perhaps operate in that space. It's hard to find them. It's a lot of work, you know, to raise capital of that size. It's much easier in lots of respects to raise, you know, 200 million rands than it is to raise 2 million rands. And so I flag that up. That's probably a useful feature just to add. And then finally, I'm just going to deal with your question because of my VC and tech background. Sebastian, you asked, you know, what's the current state and what's the foreign interest levels in the tech space? So I think in VC, the first thing is generally, if you're in our space, the 50 to 500 million rand range, the first problem is that it's very, that if you're raising 50 million rands for a startup, okay, it means your startup better be worth a lot of money or you're going to dilute to nothing. And so we don't tend generally in our space to deal with very many startups. But as a general statement, when tech is a hot area, we're seeing the exciting spaces seem to be security, with everyone working at home. You need proper security now, online security. It's amazing how quickly the banks were able to outsource that, to allow that stuff to go home, which is dangerous. And they'll all be scuttling to sort that out, of course. The communications industry, telecoms, any of those tech spaces which ensure you a decent line. We've all had a line where we've been talking to somebody and you get cut off and you curse your ISP because you were just about to get to the most important part of it. And then thirdly, we think anything that's facilitating traditional business is great. You know, e-learning, telehealth, those sorts of spaces are hot. So we think tech is a great area at the moment if you're raising capital. The other thing to say is if you're looking to raise capital from foreign investors and they're small sums of money, if you're raising 50 million rands, a foreign investor may get out of bed for that. But when you're raising small sums, it's very, very difficult to expect someone who sits in the US, for example. They've got tons of opportunities on their own doorstep. They have a huge market, the biggest tech, massive tech market on their own doorstep. They can get quickly to the places they're going, and travel is a problem at the moment. Why would they be eager to look at other places than America, for example, or Europe if you're European? So the only way you're going to get attention from people is if you're solving problems that Silicon Valley is not solving. If you're solving a quintessentially African problem with your VC, with your tech solution, you can get attention with that. The next problem is to convince an American that that's a real problem. But there are some wonderful solutions we've come up with in this continent that are inspiringly unique, because Silicon Valley doesn't worry, doesn't even know they exist. That these problems exist, because none of them, this is not their primary concern every day they wake up. So when you've got small sums involved, lots of travel, the deals are expensive, you've got Reserve Bank approvals, you've got structuring, tax, man, it's a lot of work. So very, very difficult for foreign investors to invest into VC in Africa. It's much harder than you imagine. So play the probabilities, not the possibilities. Look to your local investors for that kind of stuff as best you can, I would strongly suggest. And the final thing is, I got a beautiful house, I think. If it was in the middle of Silicon Valley, it would be worth a bomb. But it's not. It's in Durban, and it's not worth as much as it would be if it was in Silicon Valley. And the same goes for business. So I would always caution somebody who's got the next best thing to sliced bread. Just remember, if you're not located there, you don't have the networks, and you don't have the access to those markets, it's very hard to justify the similar valuation. So don't get confused too much by what Americans are paying for stuff compared to what we're paying for stuff in Africa. But anyway, that would answer that one. Maybe just finally, I'll answer.
Can I just, whilst you're on that, can I ask you a question?
Sure.
I'm involved in a transaction where they actually do not need the money, but they've been advised in the tech space to actually approach corporate finance advisors for their networks. Okay, so they still get involved, even if there isn't that great a need to raise money. Can you comment on that in this environment?
Yeah, look, I think the value of, and I'm not sure that initially I'd go to a corporate advisor for my, to provide me with strategic access to businesses. If it was strategic access to capital, corporate advisor is a good person to speak to. But if you're looking for networks you want access into Microsoft, Amazon, corporate advisor is not going to be any better place to do that than a variety of other industry players who are well dialed into the market. So I would say that that's one distinction I'd draw. The second distinction I'd draw is very often in early stage tech, you're looking for access, you're looking for wisdom, and very often you'll make a deal where the intellectual capital is more important than the financial capital. In the US to date, until recently, as we all know, money was changed. You could put anything up. You could sell a fart in a plastic bag, to be honest, if you put the word E in front of it. That's changed. It's become much more like what we know in South Africa. It's not about blitzscaling. The word blitzscale, I think, is going to disappear from the vocabulary of VCs for a little while now, and it'll only come back in years to come. But the blitzscaling theory, that works in America. It hasn't really worked here, and that's why you want. It's often not the financial capital, Maurice. The idea behind that was very. The idea really is that you want access to networks and to talent.
Yeah, I think it's needed. It's not possible without that. That's a certainty. Sorry, I interrupted you. You were busy saying something.
And just to say, in that space, there's some wonderful operators in that VC space in this country who really are dialed in. I mean, I can think of a couple of them. We've got a guy at KZN that's really dialed in. You've got Readiness. You've got Kiet in Cape Town. There's not tons. There's a couple of really good operators there, and I'd encourage you to try and engage with them, speak to them if that's your space. That's obviously not distressed so much distressed investment. Peter Duckworth's question was, what's the difference between new capital in the UK and new capital in South Africa? Just so you know, we are regulated in the UK, so we have a company in the UK, which is our sister company. We have a company in South Africa, which is the operational center for our African operations. We have an office in Australia, and we have offices in Melbourne and Sydney in Australia. It's another sister company, and we have an office in Auckland. So you'll see the branding is slightly different for Australia and New Zealand, but we're all joined up as sister companies. Yeah, I hope that's helpful.
Mark, should I take the question from Jordan from IQ Business? He's asked about a lot of delistings on the JSE with many more public businesses being suspended. How do we see the intersection between private equity takeovers, mergers, and public markets playing out over the course of the years? There was actually a webinar a couple of weeks ago hosted by 91 with Stephen Kosseff, and he pointed out that JSE is actually really lagged in terms of the way they are structured and set up for these types of crises. Largely because we were insulated from the 2008, 2009 credit crisis. A lot of the other exchanges relaxed some of their rules around the ability for companies to raise capital. And as a result, there's actually been quite a bit of capital raised in the public space on other exchanges. I'm thinking specifically Australia and the UK, US. During the lockdown, we've had nothing, zero raised on the JSE during the lockdown. And that is a big problem. So there's a lot of rules that need to be reworked and enable the smooth flow of access to capital. And that also applies to the smaller cap businesses, which have become micro caps, have absolutely no trading liquidity and really can't justify continuing to be listed on the JSE. But they face very onerous rules in order to delist. They have to make offers to minorities. It's a very expensive process, and it's very difficult for them to extract themselves from what becomes a very expensive annual process of adhering to all the requirements of being a listed company on the JSE. There's a number of other exchanges popping up. They have much cheaper mechanism for trading and being listed, and there's hopefully some precedents being set now for businesses that are able to transfer their listing without having to go through that onerous and expensive process. But I think you're going to see a lot more of that. It's going to put pressure on the JSE's profitability, so they're probably going to fight it, which is a bit of a concern. But you do need to see those businesses drop into the category where they are better able to tap capital, because their ability to tap equity capital, given their subdued share prices and low liquidity, is almost non-existent on the stock exchange. So they really can't justify being listed. So there's some work that needs to be done there to facilitate that. I hope that answers your question, Jordan.
And maybe, Barry, watch the growth of potentially of alternative stock exchanges that are online that are cheaper to run. You might see some of those stock exchanges starting to get a little more traction. The next question was, are we involved in the mining sector? Yeah, look, we do. We are definitely involved in the mining sector, and we've worked on some mining engagements with advisors. We generally avoid coal. It's very hard to raise capital for coal at the moment, and especially thermal coal. We avoid thermal. We've generally avoided thermal coal. Found it very difficult to work with. But other mining, sure. We saw some particular growth last year in the mining space. We do. There's one other question that's not on the Q&A. I've just picked it up on the webinar chat, Gordon. Maybe you could just talk about this. So it's from Barry Barachowitz. It says, guys, which sectors would you lend to, and which sectors would you stay away from at the moment? So if you were thinking as a bank, Gordon, maybe just to answer Gary's comments there.
I think to a large extent, Barry, your matrix, that the GBU one, actually answers the questions there. You know, and I mean, I can probably give a general comment. You know, I think that the property sector has become a bit vexed, so the lending into that sector will be quite cautious. Obviously, sectors like construction are a bit vexed. Sectors like tourism are obviously quite challenged. Manufacturing, I think, you know, if there's an offtake, and I think the markets will recover, I think is a promising sector. Barry, any comments? I mean, you that matrix of yours that are top of mind at the moment.
Yeah, I mean, obviously, construction, property. I mean, Gordon's published an article. When he says GBU, he's referring to good, bad, ugly. That's the link to the sector piece that we put on there.
It's the three of us on the list. The three of us are panelists, Barry. I think.
Okay. So, but it also changes. So clearly, I mean, we've obviously seen that, given specifically Gordon's expertise in the property space, we've seen a lot of incoming requests for assistance in the property space. There's definitely opportunities there. They may not be debt, they may be equity, they may be hybrid. That's clearly a space for the creative solutions we mentioned earlier to be open to. But yeah, there's going to be sectors that are definitely going to thrive as a result of this. You've seen all the online, the boom of that. That's going to be a structural trend that you'll see. And we detail a lot of those opportunities in the good column of that piece. If you want to have a look through it, we try and put some high-level comments, but also happy to discuss that offline. It's probably too long, as I said. It's also been the subject of a prior webinar with Maurice.
Emma's kindly posted it, Barry. It's on the chat, so people can see that. I just wonder if we shouldn't pick up. There's a couple of questions I see Schindler's have thrown out as well. Maybe we can just walk through that. So I'm just looking at the chat now rather than the Q&A section. So perhaps just the first question there is, does a level of stress or distress in your business affect how you approach capital raising? And indeed it does. I mean, the first thing is talk early to an advisor. If you're in stress, don't wait until you're not going to make the month end, because you're never going to raise money you just can't going to raise money. It's actually then probably time to start calling in the business rescue practitioners. So speak early. Keep a continued dialogue with your debt providers. That's really important. Can't emphasize that enough. Hiding stuff away, it's generally going to bite you in the bum. The stuff always comes out, and as Warren Buffett says, when the tide goes out, you can see he's been swimming without a swimming costume. So just don't just make sure you're communicating well, but speak to advisors early on. And the other thing is that as a business moves from becoming stressed into being fully stressed, it runs out of cash to then actually be able to pay the advisor. So now you're suddenly in a position where you've actually dropped it. It's almost like you're moving into being sucked into the gravitational force of that death spiral. It starts slowly, and then it happens very, very quickly. So move fast and be speaking to them soon. Once you get into a situation where you need a business rescue practitioner, then the process is completely different. You actually then get protection. You are protected. It's a process designed clearly to ensure that the businesses that have a reason to survive are given that chance. And at that point, the business rescue practitioner will be typically a turnaround expert, typically a specialist in managing the creditor expectations, and quite often less so focused on, they're less likely to be networked like we are, for example. And we're always very happy to work with business rescue practitioners where there's a chance that we can actually provide our network to help them extend their current reach. So that's probably a useful response.
I see. Sorry, sir, I thought you were done there. I just want to point out that there is a question by Nicolette that I'd ask that you deal with once you're done answering that question, because it's pretty specific to an industry, and I think she'd want that answered.
So this is okay. So Nicolette, so I'll just read it out. We have successfully transferred all our bookings to 2021 and already 53% better than last year this time, looking at 2021. But we need to survive to get to take these tours. However, our head office is in Mauritius. Are capital options available to businesses in this jurisdiction? And well, I think firstly the answer to that is, and we'll see this for many of us. This is going to be a lost year. It's a year that's just gone, and we've had the costs attached to them, and much of that pent-up demand will roll into next year because people will still want to go on holidays. So, so the trick is now, it's a binary trick. Can you survive that long? It's not we know that there will be good business to be done as COVID comes under more control in the year, probably next year, and the years that follow. So can you survive? So this is a crucial question that Nicolette asked, and it relates to many people. I mean, even in our own business, our business has exploded over lockdown. We've been fortunate in that regard. But much of but as that old Jewish expression goes, Jewish banking expression, I'm sure it's a wonderful expression. You make your money in the bad times, and you collect it in the good times. So you've got to be able to survive. In Nicolette's case, I would suggest that if you've got bookings for the future and they are somewhat, depending on how bankable they are, it will depend on who you speak to. There's definitely capital available in Mauritius. We do have Mauritian investors we deal with, and many of the investors in Africa route for tax purposes and a variety of other jurisdictional purposes route their activities through Mauritius and are active. So I think they'd be more than happy to look locally. It just depends how bankable those deals are. If they're bankable, you might even be able to get some kind of notional trade finance. If not, you might be able to find an equity investor who says, I love what you're doing. I can see the growth. I'd like to be in it for the future. So yes, answer is yes.
Thank you so much, guys. That's basically a wrap for today. We're out of time. That was New Capital. Thank you to my panelists. Thanks to the attendees. We have webinars every day. We have another one today at 3 o'clock, which is an economic wrap-up by Safiso. Then we pick up again on Wednesday. It's a webinar in relation to negotiation skills, and that's by Angela. She's been on before. It's absolutely brilliant, so make a note of that. Please be there. And please reach out if there's anything that you require, if there's any assistance that you require. We ask that you send us an email to info@cobra.org.za, and we'll immediately deal with it. Thanks so much, guys. Until this afternoon. Bye-bye.
Thanks, Morris. Thank you very much.
Bye-bye.
Thank you very much.
Bye-bye.